Hey, welcome to your mortgage masterclass. My name is Seth, your mortgage strategist, and today we're going to talk about rate buydowns. Historically, there are two different options when it comes to rate buydowns. One option is going to be what we call a permanent rate buydown, where you pay an upfront fee and buy down that interest rate for the life of the loan. That's typically what we call discount points. You're paying that fee to get a lower interest rate. However, today we're going to talk about temporary buydowns. Temporary buydowns are exactly what it sounds like. They are temporary in nature and are a great tool to use specifically in the kind of buyer's market today, where you're able to negotiate additional credits from the seller, and in that can be used for some temporary relief on the affordability. Again, they're not for everybody, but it's important to understand the tool, how it works, so you can decide if this is right for you and your family on any specific transaction. So first, to understand the temporary buydown. Initially, a temporary buydown is a lump sum of money that gets put aside as a prepaid interest account. And the temporary buydown is oftentimes described as like a 2-1 buydown or a 3-2-1 buydown or a 1-0 buydown or a 1-1-1 buydown. All of the numbers that are described as kind of the shorthanded nature to describe that are going to be the interest rate reduction per year. So for example, a 2-1 buy down initially starts with a 2% interest rate reduction, as if your interest rate was 2% lower the first year. And then in the second year, it's as if your interest rate is 1% lower the second year. It's interesting because we have to understand that the temporary buydown is not actually a change to the note rate or the terms of your loan. You're still locking in a fixed rate interest rate. So your note that you sign, the deed of trust, is still the 30-year fixed interest rate or the 20-year fixed interest rate or the 15-year fixed interest rate. However, there's a set aside lump sum of money, whether that's paid by the seller or the lender, or can sometimes be agent contributions as well. But that money is going to come from somewhere. It's set aside as a prepaid interest account, and it gives you credit on your monthly payment as if your interest rate was lower either that first, second, or third year. So once we understand how that works, then we can also understand that, hey, it's not some crazy loan that's out there. You're still locking in a fixed interest rate for whatever term that you decide, 30-year, 15-year, 7-year ARM, those kind of products. But then in understanding that, then we say, okay, why would we use a temporary buydown? Well, one of the most common situations is negotiating with a seller to contribute seller concessions. So for example, let's just say it was, a $700,000 house that you're purchasing, in the state of Colorado or the Denver area. That's a typical starter home. Let's say you're going to put 10% down. Well, in that 10% down, you now have a $630,000 loan amount. A typical 2-1 buy down in that scenario would cost about $15,000. That $15,000 then could be negotiated in seller concessions. So on the purchase price, you say, hey, Mr. Seller, I'm going to buy your house for $700,000, and I need you to contribute $15,000 of seller concessions. Then on the financing side of things, we can take that $15,000 of concessions. It's going to go towards the 2-1 buy down in this example. That $15,000 then is held by the lender after you close on the property in that prepaid interest account. It will then offset or give you a credit back on your monthly payment as if your interest rate was 2% lower the first year. And then as you make those payments over the next 12 months, there's still some left over. So as you go into the second year, it's as if your interest rate is 1% lower the second year. So quick example, let's just say it's the same $700,000 purchase, put 10% down, a $630,000 loan amount. Your principal and interest payment initially, let's just say at a 6% interest rate, for example, would be $3,777 per month. That's, again, just principal and interest on that payment. Initially, it would be as if your, on that first year on the 2-1 buy down, as if your payment was 2% lower. So it would actually give you a credit of $770 a month, so that it would be like you're paying a 4% interest rate the first year. And then as you moved into the second year, it would give you a credit of about $395 a month, as if your interest rate was 5% the second year. This tool is unbelievable when it comes to buying back affordability. There's a lot of people who, as they move into, whether it's your first home or upgrading a house or even right-sizing retirement, where right now some expenses are super high, or you know that income is going to catch up or follow. You're maybe waiting on raises or commissions, or I've talked to some people where they've got extreme amount of childcare right now, and they know that as their kid gets older, they're going to go to school, that childcare expense is going to go away. This is a great situation to use the temporary buy down to buy the affordability today, allowing you to get into the home that you can now live in long term. And in that temporary solution over the next 1, 2, 3 years, where you're affording that lower payment because of the temporary buy down, it allows you then to budget correctly. So then in that, oftentimes one of the questions I get, and it's a great question, is can you refinance in the time frame? So let's say, for example, we have that 2-1 buy down scenario, and in a year from now, interest rates are lower and it actually makes sense to refinance. Do I lose all that money? That's one of the best things about the tool of the temporary buy down, is all of the extra money that's sitting in that prepaid interest account is not lost. You don't lose that money. It's not a fee. So if you refinance, you have the ability to refinance at any point. Whatever's left in that prepaid interest account actually comes back to you as principal reduction. So they're not going to write you a check. You can't go buy groceries with it, but it's not lost. It comes back to your benefit, and it does pay down your loan. So that's part of the strategy looking forward, is buying the temporary buy down. Again, there is no guarantee on interest rates in the future. However, if it does make sense, you can always refinance and adopt that lower rate permanently through refinancing. Anything additional or left over in that prepaid interest account comes back to you as principal reduction, so it's not lost and all to your benefit. So that's one of the best ways that we've been using the 2-1 buy down, the 3-2-1 buy down as a strategy in today's market, is it helps buy affordability today, allowing you to get into the house. It particularly, I would argue, is best for any long-term houses. If it's that 1 to 2 year scenario, sometimes there's other places to use that money from a strategy perspective. But yeah, as you are able to get into a house, whether it's your first house, upgrade, or right sizing in the retirement season of life, this could be an incredible tool. And so don't neglect it. As part of what we talk about on the financing thing is what happens at the end. So if we're coming up with a strategy and a plan on the number side, we want to make sure that your real estate agent understands this on the front end. It's how they negotiate it in the beginning. So if you want help placing just relationship connection with some of the best real estate agents who know this strategy, know how to negotiate this strategy, please reach out. We get the honor and privilege of working with some of the best agents, and we would love to plug you in, because what we're talking about on the end conclusion, we need to make sure that your real estate agent from the beginning is negotiating correctly, so that we can use that seller credit in the best strategy for you, including a temporary buy down.